While talking about challenges in financial inclusion, I thought I would raise a challenge that's not very explicitly acknowledged in the context of pushing financial inclusion. If you look at all the people who are on the supply side of financial inclusion, the government, the Reserve Bank, the other financial sector regulators, the NGO sector, the MFI sector, all of you present here, there is an inadequate understanding of poverty. We're trying to help poor people through financial inclusion, and I believe that all of us together do not understand poverty very well. There are very many stereotypes about poverty. First of all, we think that all that the poor people want, when we give them a bank account, we want to give them a bank account because they have no avenue for saving their money. They keep it here and there and they lose it, therefore we must give them a bank account so that they can save the money. No, the poor people want a bank account, as Dr. Rangarajan said in his inaugural speech, also because they want credit. So poor people come to the banking system for financial inclusion only if we provide them all that they want, which includes saving, remittance, credit, insurance. Unless we give all of them, it is not financial inclusion. When I was governor, we pushed financial inclusion, and Ernakulam district in Kerala, that was the first district in the country to have achieved 100% family planning way back in the 70s. It was the first district in the 1980s to have achieved 100% literacy. So we took up this as a challenge and said that we will make Ernakulam the first district in the country which would achieve 100% financial inclusion. And we worked with the Union Bank of India for 1 year, pushed it. Lots of people, or everybody that was in the financial inclusion space, Government of India, the state government, Reserve Bank, all the other regulators, NABARD, Union Bank, everybody was involved in that, and we pushed. And we declared in November 2012, I think, that Ernakulam district is completely financially included, 100% financial inclusion. Then I asked the Reserve Bank to actually do a survey. And what we found was that even in a very enlightened district like Ernakulam, where almost everybody was given a bank account, people were still going to the money lender. What that taught us was that merely by giving a bank account, you're not achieving financial inclusion unless you give them all the services they want, the type of services they want, and at the time they want. The second stereotype I discovered was that we believed that the cost of credit matters a lot to the poor. It matters to them, but more than the cost of credit, I think it's the access to credit that's much more important. Lots of people used to tell me when I was governor, they tell me even now that MFIs are charging 35, 40, whatever percent, or used to did. Now there's a regulation, but they can't charge. But earlier, 35, 40%, that's usurious. Now, how do you judge if the rate of interest is usurious or not? You compare that to what Reliance or Tatas are getting from the banking system, and so this is much too high. They're getting 10 or 12 or 15%, and MFIs are lending at 35, 40%. But if you deny MFI credit, the customer or the common person, as Dr. Reddy said, is not going to get credit from the banking system. He's going to the money lender who's going to charge him 100 or 200%. So that's the comparator.
More recently, we've had another wave of new pipelines. You have the SFBs, we have the payments banks. But even before that, technology enabled a large number of other intermediaries. The prepaid mobile and the business correspondent itself is a result of technology. So just some thoughts on this pipeline issue. Are we doing the right things in terms of just expanding it as far as possible, or do we have enough knowledge to be a little more focused and a little more pointed in our choice of instruments, a choice of organizations, choice of technologies? Should we just let it be, or should we now start to focus? I won't use the word consolidate. Let me use the word focus.
My inclination is to have multiple channels, multiple instruments, multiple institutions to operate. Make sure that there is rigid provision also. not just exit in, for instance, RRBs. We somehow want them to survive. So little more on the exit side, have more entry side. And we have multiple challenges. Kerala has too many deposits coming from Middle East. Northeast is different, Nagaland is different, and different circumstances. I think there is more need, in my view. In fact, we have to get in state governments to take a little more interest in regulation of variety of other types of institutions. So next step, I believe, is how to bring in the state governments and involve them in regard to smaller types of institutions, regulation, supervision. But multiplicity is better, less risk, possible competition, and the diversity of the country and the circumstances.
But challenges to supervision, which is a
yes.
critical issue.
But as long as they are smaller and decentralized, less risk.
Dr. Jalal, Dr. Subra?
I just want to endorse what Dr. Reddy said, that India is a very large country, very large, very diverse, very heterogeneous. What works in Nagaland may not work in Odisha. What works in Kerala may not work in UP. Therefore, I think we should let 1,000 flowers bloom, encourage experimentation, mainstream those experiments which work, shun those which do not work, but I don't think we should try to develop, encourage, or look for a model that works across the country. I think we should have a diversified model. What works wherever, we should pursue that.
Okay. Dr. Jalal, any thoughts on this?
Yeah, I think nobody can disagree with this point, that you should expand the financial outreach. The most important issue that you also have to keep in mind is that financial institutions who are lending other people's money. You know, it's not that you are creating money. And we have seen what happened before the regulatory system also controlled or also supervised what you might call non-banking financial institutions, local area banks, and so on and so forth. Before that, what used to happen was that everybody, I mean, you know all these scandals that have happened, that you invite, you know, in deposits, and then you do what you want to do with it without creating any access to credit or access to facilities for the others. I mean, so I think that keeping the background in mind, a supervisory system, and where you are right, and I think this point which has been said, is that NBFCs or local area banks, cooperative banks, housing banks, self-help groups, all of them are essential. But the most vital point is that where you are dealing with other people's money, that to ensure that that money is that there is whatever the taker of that money is doing is transparent. Whatever the taker of that money is doing is according to rules, regulations, or whatever you may call it. And whatever the taker of this money is doing, that he will be held responsible for ensuring that repayment is made. That is of utmost importance. Not that you would succeed 100%, but accountability, transparency, and a complete accountability is of great importance in the financial system, because it is other people's money that every financial institution is dealing with.
From that perspective, balancing stability, consumer protection, and inclusion, how do you see this balance being achieved, and who are the sort of players in this? And Reserve Bank certainly, what should it do, and how should it include, as Dr. Reddy was referring to, you know, state governments perhaps, but we've had mixed experience with those. How do we create the regulatory framework that that is appropriate for this, to achieve this balance?
No, but this is not an issue which you can resolve today, because it's an evolving situation. With technology, now, for example, one important thing has been done to resolve that kind of issue is the Aadhaar card linkage to bank accounts. You know, mobile phones. I mean, now they have become 100% of the people, or 99.9% of the people in India have mobile phones. They have Aadhaar cards. Now that we have linked bank accounts or bank access or the financial access to them, with the linkage being provided by what you have, mobile phones, Aadhaar cards, which gives you identity, and so on and so forth. So it is an evolutionary process, And then what has been done in terms of DBT, in terms of, the transfer of money to the poor and all this is also happening technologically through the banking system, of course, but these are very important. Then postal banks. This is another idea which has flourished, but which has to take shape. So I think that we have to do as we go along. And we have to keep in mind that the requirement is safety of deposits. The requirement is accessibility to credit. The requirement is accountability of the credit provider. The requirement is to expand this whole process in a way that there is complete transparency. So it's not an easy issue. But, we have to keep an eye. And if we see that something new has come up, supposing you are using Aadhaar mobile and you find that people have created 5 mobile phones and they printed 20 Aadhaar cards with wrong numbers and so on, then you have to create a system which can prevent this and which can hold them accountable. So there is no, what you might say, 100% safety. But you have to keep a watch, you have to keep a regulatory system which is safe every 3 months. They take account of whether there has been any other development in the technological world. Hacking, for example. How do you handle hacking of your bank account? That is the issue which has just emerged. Then it will emerge more of it with robots and artificial intelligence. So what I am saying is that you have to keep your mind free and open, and you have to keep your eyes open and see how things develop. The most important thing is whatever we can do to what I talked about earlier, to ensure safety of those who are lending and security of those who are borrowing.